Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. Please call or text me at the number below anytime if you'd like me to take a look at your mortgage scenario and let you know what I can do for you. For today's mortgage rate update, we've got more good news. I've updated the stair-step chart to indicate that we are now just one step above the lowest rates that we've seen over the last 60 days. Now, I do need to clarify that although some scenarios have become better priced than they were yesterday, there are plenty of scenarios, loan amounts, product types, etc., that really haven't budged at all since yesterday. But there has been an opening for certain products, particularly high loan amounts, so between 400 and the maximum conforming limit of 510, 400. That pricing, particularly at low loan to values, is pricing approaching very, very, very close to the lowest levels we've seen over the last 60 days. In fact, in one scenario, just today, I was able to lock the lowest 30-year fixed rate that I have locked during this entire low interest rate environment. Now, this was a special situation. It's a very high loan amount, right very close to that 510, 400 limit, and also it was an incredibly low loan to value. So this highlights one thing that's very interesting, and I'm going to reference this to bond prices. So bond prices today are a little bit more favorable than they were yesterday. This is the 2-day picture. Yesterday you can see the pricing over here, and today's pricing you can see on bonds was higher, which of course higher bond prices tends to lead to lower mortgage interest rates. But one thing you'll notice, this 103.5, 103.4 level, it's actually lower than the sustained 104 plus levels that we saw on this particular bond. And the pricing in some cases is better than at the time where the bonds were priced at 104 or higher. This suggests to me that not only are we in, as I've said many times now, not only are we in essentially an artificial market as far as mortgage rates are concerned and the mortgage bond market is concerned due to the heavy involvement of the Federal Reserve's bond buying program, but we're also in a place right now where even the mortgage bonds themselves are not purely dictating where the interest rates are going on a day-to-day basis. This is frustrating on one hand because it makes it difficult for me to provide really sound advice to my viewers as far as what to look out for, what elements are going to predict lower rates. It just makes it really difficult to know what's going to happen on a day-to-day or even hour-to-hour basis. So I do have some frustration about that. But if you happen to fall into that product category with a loan amount of, let's say, above $400,000 to the conforming limit of 510, 400, this is a very, very good window. And I was able to lock, like I said, some very good terms just today in that band. As far as where things are going tomorrow or the next day after that, I'll reiterate what I've said over the last few videos, that I am not seeing anything that's giving me any predictive powers, especially because this market is it's really just quite strange. I'm going to transition from there for today's quick tip. The quick tip today is related to something I don't want to say I felt bad about it, but there's a whole segment of the population that's essentially been left out of the general low interest rate trend. And that includes borrowers that are looking at government loan programs that happen to have credit scores lower than, say, 680. This product category has been really, really damaged by everything that's gone on with the instability in the mortgage market. Essentially what's happened is the mortgage investors, and there's some opinion included in what I'm about to say, but it's backed up, I'd say, pretty strongly with a fair amount of evidence and things that I've read as far as market publications and whatnot. There's so much volume going into the system right now for what we would call maybe prime category loans. These are your standard conventional products backed by Fannie Mae and Freddie Mac. There's so much volume going into the system. The big mortgage investors are taking on probably more than they can even handle in terms of volume. And so what they've done is they've essentially established measures which are preventing borrowers that are on, let's say, FHA loans, VA loans with credit scores below 680 from really getting the benefit of the low interest rate environment. There are certain categories. I've got one borrower in particular, FHA borrower with a 650 credit score. And for his particular case, in order to get even a halfway decent interest rate, basically the mortgage rate sheets were set up in such a way that he had to pay points in order to even get onto the rate sheet. And essentially what's happened is the big mortgage investors are establishing a strong preference for prime scenarios, these conventional products that are backed by Fannie and Freddie, and they're essentially leaving FHA borrowers and in some cases VA borrowers behind if they don't happen to have top-tier credit scores. Even the government loans, say for FHA, for borrowers with higher credit scores, those rates are simply not as low as the conventional rates. So my quick tip for today, if you happen to be looking for an FHA loan or a VA loan and you have a credit score that is in that range that currently you're just getting hammered with either higher than normal interest rates and or points, the best thing that you can do is to bump up your credit score as quickly as possible. Now, there are a lot of different strategies for how to build or improve your credit rating, but the one that is the fastest, assuming that you have the means to do so, is reducing the balances on your revolving credit accounts. So this would be basically credit cards. Whatever you can do to get the balances on your credit cards to less than 50%, less than 30% of the overall limit on the card, that is going to result in a nearly instantaneous increase in your credit score. And particularly if you're right on the borderline, let's say you've got a 670 score and you're looking for an FHA loan, even bumping it up 10 points to get to 680 or above is going to give you much, much better pricing on your mortgage. And I would be more than happy to help provide some specific guidance for anybody that needs some help with that. I can take a quick look at your credit report and I can give you some very precise guidance on what to do. Now, one last element of this quick tip. I am not a fan of many, let's just say many, credit repair agencies. A lot of these agencies come out with a very strong sales pitch that they have such and such of a track record of getting people's scores increased by X number of points. And essentially what they engage in are marginally, let's call it very gray area strategies. And this essentially involves dispute letters. It involves essentially trying to modify the past history of your credit profile to get you a better credit score. Now, these strategies in some cases work. In some cases, after dispute, a creditor will relent and maybe modify a credit record, and that could result in an increase in your credit score. The problem I have with these credit repair outfits in general is that they do not emphasize, in my experience and in my opinion, they do not emphasize the credit fundamentals that will put their clients in a position to have a better credit score. And the fundamentals are really, really very simple. On-time payments. If you're going to go late, don't go over 30 days late. Do your absolute best to keep your balances to below 50% or even better, below 30% of the limits on your credit accounts. Maintain at least 3 active credit trade lines. So a trade line refers to a single credit account, and you want to make sure to have a mix of credit in there. Having just an installment loan or just installment loans is not ideal. You want to have at least one, preferably more, revolving credit accounts, so credit cards. Having revolving credit as part of the overall credit mix and showing that you are not extending those credit lines to their absolute maximum and showing that you're making on time or at least not over 30 days late payments on those accounts, that is what's going to build a better credit score. And a lot of the tricks and the kind of gray area strategies, I just don't recommend. Now, if you have a legitimate grievance with an account that's being reported inaccurately, so a late payment that's inaccurate, a collection that is inaccurate, something of that nature, your best bet, and this is maybe the most important tip in this whole video here, your best bet is not to rely on the credit bureau's dispute process. The dispute process available to you through the credit agencies really doesn't work. What it's going to do is it's going to throw a dispute flag on that account. It's going to remove that account entirely from your credit score, so it may result in an increase in your credit score. But anytime you apply for a mortgage, at least, we're going to require that any account in a dispute status, that dispute is removed. And if the dispute doesn't work in your favor, if the creditor simply affirms the data as they've reported it, what you're going to end up is a situation where you thought you had a higher credit score. As soon as the dispute is removed, the credit score goes right back down. So long story short, your best strategy, don't rely on the credit bureau's dispute process. If you have a legitimate grievance, first contact the company, see what you can do. You may need to go up the phone tree a little bit to talk to a supervisor, make your case. If you have documentation, that's even better. If they are unwilling to help you, or if they're unwilling to modify the inaccuracy, your next step is to file a complaint with the Consumer Financial Protection Bureau. I'm going to put their link in the video description, but it's consumerfinance.gov. If you make a dispute through this government agency, I can almost guarantee you will at least get a response. These creditors take a dispute through this agency very seriously because the CFPB has extraordinary powers, including the ability to fine bad actors that are not willing to report credit information accurately for consumers. So that's my advice on that. I'm going to talk a little bit more about government program rates. I'll keep people up to date on that. Please do like the video. Please subscribe to the channel. Please share my video with anybody that may find it useful. Thank you so much.